Yeah, I think that's certainly a fairly valid point. There have been some big changes, but I think they mostly apply to Mexico. So one of the things we've changed is these new labour input requirements, where a certain proportion of autos have to be made by workers earning sort of high wages, so above $16 an hour. From Canada's perspective, that's quite good. It could actually see some investment shift from Mexico back to the US and Canada. The sunset clause, though, I think that isn't quite important. Even though it is 16 years, that's quite a long time even from an investment perspective. You've also got a review period after 6 years. So that introduces an additional dose of uncertainty. Donald Trump could still be president in 6 years' time, and that could hold some investment back.
But even if he's not, this is the problem with going back to the table to renegotiate a lot of these deals. It means that a future US president could do the same thing, because they've opened Pandora's box on these deals that perhaps in the past there might have been a reluctance to go in there and really take the bat to key neighbours and trade partners. So are you saying we could be right back in this situation if it's used as a hot button election issue with voters?
I think definitely so, especially with that 16 years, maybe not for the next couple of elections, but certainly it becomes more of a sticking point because the politicians have to actively put their support behind it. And clearly we've had some governments in all three countries which are less supportive of NAFTA than others. And as that becomes an issue, they might say, well, we could win some votes here. And certainly, yeah, it's a bit of a sticking point. It could see investment from the two smaller countries go to more to the United States and the larger market there.
There's been a level of caution coming through from the auto industry on the back of the New Deal, and you wonder whether that's just because they're so shell-shocked because they're looking at ripping up some of the global distribution channels, and now they're not doing that, so they might be just a little bit relieved and still somewhat shell-shocked by the overall experience. The other point is that, will workers actually find these increased jobs down the track, because we all know automation is coming very thick and fast to manufacturing. If those jobs are going to be that much more expensive, eventually there's this cost equation. Do I just put in more AI? Do I put in more automation? And that removes the requirement to bulk up on workers. Yeah,
exactly. That's the whole problem with this debate on globalization is we don't know how much is automation and how much is offshoring work elsewhere. So certainly as an issue, there could be a short-term boost, I think, but in the long term, we are obviously still dealing with those issues. And companies are still going to be very much aware that there might not be tariffs on cars, but we've still got the tariffs on metals. That's an input cost. That's going to make business harder. Even if there's tariffs on all countries, you know, there's a limit to how much consumers can actually pay for these goods, and that's going to weigh on demand.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.